Hi everyone, I'm Ricardo Lopez, and I'm the California economy reporter for the Los Angeles Times. Welcome. Today, the UCLA Anderson Forecast released its quarterly report, looking forward to what lies ahead for the U.S. and the California economy. With me today, we have David Shulman and Jerry Nickelsburg, both senior economists with the forecast. And David was the author of the U.S. forecast that was released today, and Jerry wrote the forecast for California. Very quickly, we're going to go to the U.S. forecast. So we're going to start with you, David.
Okay.
David, your forecast says that monthly job gains of 160,000 a month isn't going to make much of a dent in the unemployment rate. Can you tell us what is the holdup? Why is the U.S. economy lagging?
Well, the thing is we have a huge overhang from the financial crisis of 2007 to 2009. And then the other thing is we have a structural readjustment where a whole bunch of jobs were lost that will never come back, and a lot of those were in manufacturing and construction. And the third thing is we're not generating enough economic growth to get more than, say, 150, 160,000 jobs next year. And in order to lower the unemployment rate, you have to grow at least 125, 130,000 jobs a year, because that's the normal increase in population and a natural increase in the labor force.
Right. And so I think in your forecast you said that the unemployment rate won't fall below 8% until 2014, which is quite a ways away. What is going to happen in 2014 that is going to accelerate the pace of recovery?
Well, what's going to happen is we'll have a rebound in non-residential construction. We'll continue to have strong gains in residential construction. And we're assuming is that the recession in Europe and the slowdown in China will be behind us, so exports will begin to increase, and capital spending by businesses will also be increasing. So that could get economic growth from below 2% to above 3% sometime at the end of 2013 into the beginning of 2014.
Right. Tell us a bit more about the housing rebound, because I think that was one of the brighter spots in the report. You mentioned we're beginning to see signs of a turnaround in the housing markets. How critical is that to the recovery?
Well, I think is in 2014 it's probably worth about 1 point to the GDP. So that's the reason that we're going to go from 2 to 3. It'll be largely on the back of housing. Housing has been depressed so long that any little change in demand will help the market a great deal. We have record low mortgage rates. We have people who are still working. There's less likelihood of being laid off, and there's pent-up demand for houses. So the way we characterize the housing recovery is last year around 600,000. This year will be about 770. Next year will be about 1 million. And when you go from 600,000 to 1 million, that's going from depression level to recession level. So that's not really a big deal in terms of getting back to normal. And by 2014, all we're saying is we'll get back to normal around 1,300,000, 1,400,000. And that's sort of the long-term average for housing starts. So going from depression to recession to normal. So we don't think this is a heroic forecast. And the data we got yesterday was consistent with the forecast in terms of building permits now for 2 months in a row have been running over 800,000 a month.
Right. Tell us a bit of some of the weaknesses ahead. I think in your report you mentioned that there is, we have a global economy that's slowing, but we're also seeing the looming fiscal cliff. That's when we're going to have the end of the year tax cuts expire and some automatic spending cuts kick in if Congress doesn't do anything about it. Is that how big of a risk is the fiscal cliff?
The fiscal cliff, I think, is a huge risk because we're acting with the triumph of hope over experience that Congress and the White House are going to end up do the right thing and we'll end up with some kind of reasonable compromise. But what we will get on January 2nd is a $500 billion tax increase, and that will affect everybody. That will affect everybody who pays Social Security taxes because that 2-point reduction is going to go away. It will affect everybody who pays income taxes because the 10% rate will go to 15%. Will also everybody a lot of folks right now who do not pay the alternative minimum tax will pay the alternative minimum tax. And there'll be a massive tax increase across the entire economy, along with $100 billion of sequestration of spending, half defense, half non-defense.
Mm-hmm.
And what the CBO, the Congressional Budget Office, says is that says GDP drops by 4% in the first quarter, 1% in the second quarter, and unemployment goes to 9%. So that's on their numbers. My guess is it will be worse than what they're suggesting, but what they're suggesting is pretty bad. So it depends on the politicians at least coming up with some kind of reasonable compromise.
Right. And so if the fiscal cliff happens and all these tax cuts expire, we see the spending cuts kick in, would it push the U.S. into another recession?
Yes, that's what I just said. It will put. And the tax increases are a far bigger effect than what people are talking about with the spending reductions. And the other thing with the spending reductions is that every defense contractor on October 2nd, 90 days prior to when this will take effect, will send out layoff notices to their entire workforce, because under the planned closing laws, you got to get 90 days notice before you do a big layoff. So they're going to be sending out layoff notices on October 2nd.
Right. And talk to me about, because I think the report at the U.S. level predicts that there's going to be a net gain in exports. Is that going
Exports are going up, but they're going up at a slower rate. Exports, which are going at 10%, are slowing to around 6 or 7%. Next year will be around 4%, because it's hard to export into declining economies, especially with Europe in recession. So we were hoping that exports were going to lead us out of it. It was going to be one of the real great growth drivers next year. That's going to have to be put off a year because the rest of the world isn't doing all that well.
Right, great. Well, we're going to switch gears really quickly here. We're going to jump to Jerry. Jerry, you wrote the report that focused on California's economy. And in this report, you focus particularly on exports. Can you tell us, I mean, for some of our viewers, can you tell us why exports are such a substantial part of the California economy?
Well, California sits in a unique and advantageous geographical position on the edge of the Pacific Rim, and the Pacific Rim has been and will be the most dynamic economic region in the world. So California is an exporting state, both directly and indirectly, with its high-tech components going on airplanes and another machinery that is being shipped to Europe and to Asia. And as David has alluded to, the situation in Europe is one of recession today. We have assumed in the forecast that they get past that recession, that it's a mild recession. But the question is, if it becomes a major recession, if they don't solve the sovereign debt problems, then what happens to California? Because we export quite a bit to Europe and quite a bit to China, and China's biggest export market is, in fact, Europe. So between the two of them, that accounts for a quarter of California's direct exports.
Right.
So the question that we wanted to answer was, how exposed is California? And the answer is a little more than the U.S. because we are a globalized state, but only marginally so.
Right. And so, I mean, in this scenario, you mentioned that if there, I mean, barring any other, changes in the global economy, but if we have an implosion of the Eurozone, and if we also have, the slowdown in China affecting California exports, what could that mean in terms of jobs? I mean, I think you said that there's a potential for job losses if the exports drop off.
Right. So there are many scenarios, and we didn't study all of the scenarios. But I think that you can look for, with the euro coming apart, depending on how bad the recession might be in Europe, for a loss somewhere in the 165 to 200,000 job range, which takes us back a ways and erodes some of the job gains that we had. Now, we don't think this is the most likely scenario. We don't really think this is what's going to happen, but it's not out of the realm of possibilities.
Right. And I mean, if that occurs, I mean, what does that mean for California's recovery? Because I think in the past year, the state has gained something like 360,000 non-farm payroll jobs. And if those job losses occur, what does that mean for the recovery? Is it a big derailment, or is it just another blip?
Well, if we have a total coming apart of the euro, which we don't think will happen,
right,
but just thinking about sort of a worst case kind of scenario, a big recession in Europe will definitely affect the U.S. and will affect California, similarly. So we haven't studied, in a sort of an integrated way, a European U.S. economy and what that means in terms of recession or just getting by with near zero growth. But at any rate, what it does mean is that we're going to have an erosion of some of the gains that we made in the last year. and it will certainly set back at least a year the recovery in California.
Right. And speaking of the recovery here in California, can you characterize the pace of it? I mean, I think in the past 3 months, we've seen more widespread gains across different sectors. But overall, I mean, what's been leading the recovery in California, and what are you seeing in the past 3 jobs reports?
Sure. So as we came out of this recession in the early part of 2010, what we saw was that the Bay Area and San Diego were growing faster than the U.S. And this was because of investment in equipment and software. These are technology-heavy areas. That expanded to be all up and down the coast, and now we're seeing over the last year that we are experiencing an expansion of jobs throughout the state. So that's good news for California. We've also had an increase in tourism, particularly international tourism, and the energy and mining boom, which has been sweeping across the U.S., has hit California. And so some hard-hit parts of California, such as Kern County, which is rich in energy, are now starting to boom. So we've got a widespread recovery going on now. As I say, it started with technology-laden industries. It's still being powered by that, but others are starting to get some momentum.
Great. And then I'm just going to jump back to David really quick because I want to get just kind of the takeaways from both of the reports. I mean, David, the takeaway message from your report on the U.S. forecast is what exactly?
Well, the takeaway is the title. It's muddling through. I mean, near term, we're going to be muddling through. We're going to be growing, but not really fast enough to mop up unemployment, and as we get into 2014, we'll begin to get that growth, and the unemployment rate will come down, and the world will be a better place. The economy will be a better place, and we just got to get over this European recession, slow down globally, and we got to do something reasonable with respect to the fiscal cliff.
And Jerry, can you tell us? I mean, for California, absent the scenario that's in the report of exports dropping off. What is California's recovery going to look like going into the end of the forecast period, which I think is the last quarter of 2014?
That is correct. So as David said, for the U.S. economy, we are muddling through. We are growing slowly. The bad news is that we're muddling through. The good news for California is it's a little faster muddle than for the U.S. And so we see the unemployment rate coming down as with the U.S., but at a faster rate, so that at the end of our forecast, which is the fourth quarter of 2014, what we're looking at is California to have an unemployment rate of 7.9%, and that's about 0.5% higher than the U.S. So we really will be closing the gap over the next 2 years in the most likely scenario.
Right. And then this question is going to be for both of you. We're going to be wrapping up here pretty soon, but so tomorrow we're having the state jobs report come in. What are your predictions for what the numbers might look like tomorrow? We'll start with David and then Jerry.
I'll pass to Jerry. I do the U.S.
All right, Jerry, go ahead.
Okay. So in the last 6-8 months, California has added more jobs, added jobs at a faster rate than the U.S. So more than our 12% share. But the last U.S. jobs report was really very muted, so we expect the same for California, that we will gain some jobs, but typically when the U.S. slows down, California slows down fairly dramatically as well. So we're not looking for large or dramatic gains tomorrow.
Great. Well, thank you both very much for joining us today. Again, I was with David Shulman and Jerry Nickelsburg, both senior economists at the UCLA Anderson Forecast. If you to follow our coverage, follow our Money and Company blog on latimes.com. And again, thank you both very much for joining us today.
Thank you.
Our pleasure.